Hey guys, it's Dave from MortgageGuy.com. And this article coming out and going over how those low interest rates that people got during the COVID years, even maybe when they bought the home or refinance, are becoming bigger topics when it comes to couples wanting to divorce. And in this video, I'm going to break down some of the things they talk about and ideas to help you with this and some of my own. But first, so low interest rates. You're wanting to get a divorce, but you got a 2.8 like the lady in this article. What are your concerns here? If I've got to refinance to pay off my spouse, I may be taking a rate in the sixes, let's say, right? Which I'd rather avoid. So let's talk about all the possibilities here. First off is obvious. Get divorced, bite the bullet, do what you have to do. It beats the heck out of one of the suggestions, which is to stay together in the house, even though you're divorced because of the interest rate. That sounds miserable. So first is if you're getting divorced and the house was awarded to the spouse, but you need to pay the other spouse for maybe, let's say, their equity. Number one, you want to make sure any divorce says that the house and the mortgage is awarded to one person. The reason why is because the other person, when they go to qualify for a mortgage, that past home won't count against them, even if they're still on the mortgage. Okay, because keep in mind, the divorce supersedes the mortgage of that home during underwriting. Meaning, if it was awarded to the wife, then the husband, that mortgage is not counted against them as a bill, as an example. So don't think that because you're getting divorced, you have to refinance. You don't have to.
You don't have to.
So let's say you need to pay some of that money to them in the form of the equity that's in the home. You could do a home equity line of credit. This is a second mortgage to help access some of that cash in the home. So you would leave your first mortgage at 2.8 and get a home equity line of credit for the money that you need. Now, yes, that interest rate will be higher. It could be variable. There's a lot of things that go into that, but it's on a smaller amount. Let's say you only need $60,000, but your mortgage is $300,000. Well, you're only paying 6%, 6.5%, 7% on $60,000. So less painful. You could also do an Owelty lien, which is where whatever you owe would be put as a lien on the title of the home. And then at a future date, you would refinance and that money would be paid off to the former spouse. Some of that depends on, do you have enough equity to access cash? If you don't, then this is a great route, or maybe to do something down the line. Let's say that you agree to sell the home after the kids get out of high school in, let's say, 5 years. They could leave the lien on the house, and then when you sell it, the former spouse will be paid off. That also helps you avoid. You could try to do a lease back of some sort. You could look to keep that house and rent it out and go buy a new home. So that way you're still getting the benefits of that low rate, depending on what you're having to do in the big picture of things. So there's a lot of angles that if that's your concern, there's ways of working around it. At the end of the day, yes, getting a higher rate would suck, but living with somebody you don't want to live with is way worse. So if that's a deciding factor for you, get with myself or your realtor to really know all of your options and know the truth. Don't default to assumptions or even articles about stuff. Talk to a professional, know all of your options, and let's see what's best for you. Hope you found that information helpful. If you did, I would love to be your lender, and stick around for this next video. I think you're gonna like it. Thanks, guys.